Good morning, everyone. Thank you for joining us today. I am Laura Labanier-Kitson, your CalTRUST CEO, and today we are doing one of our post-Fed meeting market updates. Joining us, we have Will Goldthwait, portfolio strategist with State Street Investment Management, who is CalTRUST investment management team, joining us today to talk through what is going on in the world. I feel like that every month the question is still questionable. Please, let's make this interactive. We have the chat feature is enabled as well as the Q&A. So feel free to pop in, give us your thoughts, give us your questions, and make this helpful for you. This will be recorded, and so you will be able to reference this as well once we get it posted to our website. Before I launch in, I'm going to let Will go and do our fun legal disclaimer that has to start every webinar, and then we will launch in to talk about what is going on these days.
Yeah, absolutely. Thanks, Laura. Great to be here. Great to be chatting. So I do have to read the disclaimer, and that is this webinar is intended for the confidential use of clients and prospects of CalTRUST. It's not open to the press. Any review, dissemination, distribution, or copying of this webinar is strictly prohibited. Comments made by Laura and I are our opinions and not of our respective firms, State Street and CalTRUST. And comments do not constitute investment advice or analytical research, and you should not rely on our comments as investment advice or analytical research. And we are recording this on September 22nd, Monday at 10 a.m. Pacific. So that is my disclaimer. That's out of the way.
All right, great job. So let's just launch right in. We had the Fed meeting last week, and there's obviously been a lot of attention and news around what's going on at the Fed recently. So is the Fed going to remain independent? How have the changes in FOMC impacted last week's vote? Should we be scared? What are we seeing when we think about the independence of the Fed and kind of where we're going right now?
Yeah, I would say this is probably the number one question I get. And I'm going to share my screen, and I'm just going to use this slide deck as a reference point. This is the deck that I used last week at the California JPA conference. And I want to hit on one slide that is, I think, particularly important when we consider the Fed's independence. So I just give a quick history here. So the Fed, founded in 1913, the Open Market Investment Committee, 1923, the FOMC, which is what we know that Open Market Investment Committee to be, was established by the Banking Act in 1935. That's an act of Congress. Then in 1951, the Treasury-Fed Accord reaffirms or affirms the Fed's independence in monetary policy. Again, that's another act of Congress. And I'm emphasizing the act of Congress because it's not the president, it's not one person, it's the Congress that comes together to create the Fed's independence. And that's just really important to think about in this time when we are experiencing a president putting extraordinary pressure on the Fed. Then in 1977, the Federal Reserve Act is amended to define the Fed's dual mandate. That's maximum employment and price stability. So again, that's an act of Congress. So the reason I emphasize that is because the Fed has a long history, 100-year history of being independent and taking that responsibility of their independence so to heart. So it's so important for them to remain independent. So that's just very important for us to recognize that long history, the institutional independence of that organization. So we don't necessarily think about Chair Powell or one or two particular governors, but we're thinking about that entire institution. There's hundreds of people that work for the Federal Reserve Bank, hundreds of people across the country, and they all believe really strongly about this independence. So then when we think about who makes up this committee, this Federal Open Market Committee that determines what policy interest rates are. There's 12 members. 7 of them are appointed by the president and confirmed by the Senate. Again, appointed by the president, but confirmed by the Senate. So there's some process there. And then the 8th is the Federal Reserve Bank of New York president. They hold a permanent seat just because so much of their open market operations goes through that New York branch. And then there's 4 rotating seats held by the presidents of the remaining 11 banks. And those are 1-year terms. So those 4 members, they will rotate on to the FOMC for a year, then they'll rotate off. And you can see I've listed on that slide, you can see Boston, New York, Philadelphia, Cleveland, et cetera. You can see all of the different 11 regional banks. So that's super important. So now when we look at the actual composition, you see the year that's bracketed there is when their term expires. So the 12 members of the FOMC, of the 7 that are nominated by the president and appointed by the Senate, they are on there for 14-year terms. And the reason it's 14 years is because they want it to be very independent from the presidential cycles, right? We know that a president can only be president for 4 years at a time, 2 consecutive terms, or 8 total years. And so they wanted these members of the FOMC to be independent of that cycle. And so you can see where the people on that committee now, Jerome Powell, 2028, Philip Jefferson, not till 2036, Michael Barr, 32. I won't read that whole list, but you can see how those FOMC terms expire. Now, of course, at any point, someone could resign early from their term, which is exactly what Adriana Kugler did. Her term was set to expire in January of 2026, but she resigned. So then Stephen Mirren gets appointed by the president, confirmed by the Senate, but he's only on until Kugler's term expires. So the reason Mirren got on there so quickly is because the Senate said, okay, he's only there until January 2026. It's not like they were electing him for a 14-year term. And that's why that process went so quickly. And then Lisa Cook, that's obviously a question mark. There's challenges for Cook right now in the courts. But you can see Christopher Waller, 2030, et cetera. And then the 8th is the John Williams, the head of the New York Fed, and then the remaining 4. So it's those 12 people that come together in a room and decide monetary policy. So if the president is going to have some influence, he needs to be able to influence a lot of those members. I'm not saying that he probably can influence, and you can see with Mirren's vote at last week's meeting, Mirren voted for a 50% cut in interest rates, right? But that dissent didn't even really get any headlines because everyone kind of knew that that's what Mirren was going to do. So I think the point that I want to emphasize to the listeners today, Laura, is there's huge institutional history around Fed independence. There's safeguards around the FOMC members as far as the length of their term. And then there's just the size of the committee, the 12 members on the committee, all very established and well-regarded economists. So I think it's, in my opinion, it's very safe to think that the Fed will remain independent.
That's comforting. Well, leading off of that, there's so much policy uncertainty right now. How uncertain is all the uncertainty? Do we think that uncertainty is going to decline? Does our crystal ball give you an idea of when we think there'll be some more policy certainty? Talk to us a little bit about what's going on with with policy right now.
Yeah, no, it's a really good point. So here's a pretty good depiction of what the uncertainty looks like. So Baker, Bloom, and Davis, they have a economic policy uncertainty index. They scan a whole series of newspapers and publications, magazines, et cetera, and pull, and they pick up on keywords. And you can see by that 6-month moving average, that we are at historic highs as far as policy uncertainty. This chart goes back all the way to 1985, and you can see that we are at historically high levels. So I think given the disruption or the fracturing, I think, of politics, given the style of our current president. He likes to create that uncertainty. That's sort of the world that he likes and lives in. This isn't really going away. But the thing that I want you to also look at here is volatility. When we look at volatility of interest rates, this chart goes all the way back to 1991, and it's representing the MOVE index, which is something that measures option volatility. So the same option treasury volatility. So the same way the VIX measures equity volatility, the MOVE index measures fixed income or treasury volatility. If we look at that chart and we look at the averages on that chart, you can see that what we are now getting used to is an interest rate environment where volatility looks more like it looked back 3 decades ago. So the 1990s and into the early 2000s, where economic uncertainty or economic indicators were more volatile, interest rates were higher, quantitative easing and a Fed's large balance sheet wasn't so much part of the narrative. Um, and frankly, we hadn't entered into the zero interest rate environment. And so when we were in the zero interest rate environment for, almost 15 years, it was a very unusual time. The Fed was the buyer of treasuries. Interest rates are pinned at zero. There just wasn't a lot of space for interest rates to move around. And so we had this subdued feeling around volatility, like yields didn't move, spreads were pretty consistent. And we had some mild shocks, of course, through that period. But overall, interest rate volatility was very low. I think what I'm emphasizing to this audience is that we're moving back to a more normal interest rate volatility period. When interest rates aren't pinned at zero, and when the Fed is not involved in quantitative easing, buying of bonds out of the market on a regular basis, then you've got interest rates that can move around. Put on top of that a period at which we're moving into probably more of a contractionary growth environment and the economic data is more volatile, then we're just going to see bigger price moves. So the message that I'm sharing with folks is if you are going out and buying bonds, if you're going into the marketplace and putting money to work and buying fixed income assets, just be prepared for a little bit more of that volatility. So perhaps you want to space out your buys a little bit more, rather than doing it all at once on one particular day. Maybe you want to space that out in increments. Maybe you want to do it over 3 days or over 3 weeks or whatever that timing is, but just be prepared for interest rates to move around a little bit more and therefore not just sort of blindly saying, all right, I'm going to buy it today. The price is the price. Be looking at what some economic indicators are, looking what quarter end calendar dates look like, and then maybe spreading out those purchases. So that's the takeaway for me in this period of greater uncertainty.
Well, since you mentioned T-bills, what are we expecting for T-bill supply for the rest of this year into next year? Do we think with the increase in T-bill issuance, are we looking at strong inflows to money market funds? How should we think about balancing cash between these options?
Yeah, T-bill supply has really been remarkable. Here's a chart that just shows overall Treasury indebtedness and then where Treasury bill percent of overall debt had been and then where it is now. So if you look to the left of that chart, you can see the blue line represents Treasury bills as a percent of overall Treasury debt. And you can see how that was in the low teens. We got as low as like 11% at one point. Then with COVID and subsequently since COVID, T-bills have been a much larger percentage of overall Treasury indebtedness. Now, some of the reason for this is because this is where the Treasury knows that they can issue debt without disrupting yields too much. And so they're doing that. Scott Bessent has made it clear that he's going to lean on Treasury bill supply. And then when you look at the auction calendar, you can see how this is the weekly Treasury bill auctions. So we went from pre-2023, which is just before the debt ceiling crisis was resolved in June of 2023, we went from weekly T-bill auctions of somewhere between 250 to 300 billion. We're now closer to 450 billion per week. So a dramatic increase in T-bill supply. And this is great for us, right? We're liquidity investors, we're front-end investors. All of that additional supply has been a wonderful thing for us because we've been able to buy it. It's caused market rates to cheapen up a little bit. And so this is something that's, hey, who doesn't want, more Treasury bill supply? I don't think anyone would say no to that. So this is a good thing for short-term investors. We do expect that the Treasury will continue to issue additional supply. Just as the government needs to borrow more money, this is just the easiest and best place for the Treasury to get that supply done. I don't have an estimate on exactly how much is left to do. Before the debt ceiling was resolved in July, there was an expectation that they would need to do a $500 billion worth of new T-bill issuance. I don't know where we are in that process, but there's one thing is for sure: we will continue to see plenty of Treasury bill supply, given the government spending that's needing to be done.
Great. Let's talk a little bit about people now. Let's talk about unemployment, labor market.
Yep.
Unemployment rates are still historically low, but no one is hiring. What is going on with the labor market? Is this a supply issue? Is this a demand issue? What's happening right now?
Yeah. Yeah, the labor market is fascinating. It's really interesting. I'm going to just give you a quick lesson on what the Fed, not lesson, I'm just going to highlight what the Fed was looking at last year before they cut interest rates by 50 basis points a year ago, September. So you can see that red circle there. That's highlighting the fact that the 3-month moving average of the non-farm payroll number, this is the number that gets released by the BLS the first Friday of every month, was really trending lower. And that scared the Fed. The Fed was like, uh-oh, we've got a labor problem. So if we take a step back and think about what that dual mandate is, the dual mandate is full employment, or making sure everyone's got as many people as can have jobs, as well as keeping prices stable. So jobs, inflation. The inflation side, the Fed knew that they were failing on, and they had been failing on since 2021. They raised interest rates at an extraordinary pace, 525 basis points in 14 months, and rates were very restrictive. But at the beginning of last year, they were starting to talk a little bit more about the labor market. They were saying prices are coming down, inflation is stabilizing. I'm not saying prices were declining, but the rate of change on prices was slowing, and so inflation was slowing. But the jobs thing started to get their attention. They're starting to worry because we all know if the labor market goes, then the economy goes. If people start to lose their jobs, then we typically end up in a recession. You might recall we talked a lot about the SSIM rule, which is looking at the uptick in unemployment rate. There's a whole bunch of things that people were getting anxious about, but this number right here was what got the Fed worried. Well, then we got the September payroll number. Boom, job market seemed to accelerate again. But then come the beginning of this year, you can see that green line and where it's trending. You can also see that blue line, which marks the unemployment rate, and you can see where that's trending. So now the Fed says, okay, we might have a challenge in the labor market. The other thing that was happening, and this caused a very high profile dismissal. The president dismissed the head of the Bureau of Labor Statistics. But there are revisions. And let me just describe for a second how the BLS compiles this non-farm payroll number. So the BLS reaches out to about 600,000 participants to compile this. They reach out to people, the household survey, they reach out to businesses to determine are people being hired or are businesses hiring. They can compile all of the data in enough time to produce to publish on that first Friday of the month. So they compile as much as they can. They might have 30 or 40% of the data compiled, and then they release the number. And they release the number plugging it into a model that projects how the rest of the data will come in. So let's say this is an August payroll number. So on the first Friday of September, they release it. And then in the first Friday of October, they release the first revision. In other words, they're continuing to collect data for August, and they release the first revision in October. Then on the first Friday of November, they release the second and final revision. So this number gets 3 looks at it. You get the first publication, first revision, second revision. When you're going through a transition, when an economy is going from expansion to contraction or from contraction to expansion, there's going to be noise in the data. So when the BLS puts it into their model, there's going to be noise. The model is not going to predict some of those transitions. And that's exactly what we've been witnessing. And you can see the red circle on the left side of this chart shows pre-COVID and how the data was more or less revising and coming in, right around the 0 marker. In other words, not big revisions upward or downward, pretty close. But if you look to the far right of that chart, you can see the revisions that have been coming in recently have been deeply negative. So no one was really surprised when we got those massive revisions on the July number that caused the firing of the head of the BLS, and then ultimately when we got massive revisions again on the September data. No one was like anyone that had been watching this number was not surprised. Yes, we've been seeing negative revisions pointing to a weaker job market. And then the last thing I'll say on this, Laura, and then I'll answer your question specifically. At the end, semi-annually, the BLS will go and audit the data using actual insurance claims, jobless insurance claims, and then they revise the model using the birth death. And birth death does not mean people being born and dying, it's companies coming into existence and going out of business. And so then they'll use that data to make an ultimate revision to the overall, and they'll basically use that data to adjust their models. So going forward. So we just saw a massive revision in that, down 911,000. This is the information that the Fed is now saying, okay, it looks like the trend in the labor market is definitely weakening. And so we need to now begin to pivot and start to lower rates. The
Well,
thing, yeah.
maybe on, has the change in leadership at the BLS affected this data collection process at all? Are we going to see it affected because of that change, or do we think they're going to continue on the same processes they've been using?
Yeah, so it's a great question, and this is whatever. I mean, not yet. Not yet. It's very possible that the new head of the BLS wants to institute changes to how they collect this data. It's very, very possible. One of the questions that's been brought up is like, should we be releasing August's payroll number on the first Friday of September, or should we wait till October?
Mhm.
Right? I mean, if this data is so noisy, why are we publishing it so soon? Should we wait till we have more data? Then the other thing that gets asked a lot is the collection methodology good? Like, does anyone answer surveys anymore? How are we getting this information from businesses? What businesses are submitting the information? What businesses aren't submitting the information? So there's a whole bunch of questions that I know will get asked, and potentially they revise their methodology. But the other thing that's really interesting about this job data is we're seeing major revisions down in employment data. So we know that there are fewer jobs in the economy than we originally thought. The other thing that's happening is people are not quitting as much. So the quit rate, that dark line, that's dropped off. So people are not voluntarily leaving an employment. But the other thing that we're also seeing is we have a much lower participation rate. So this gets back to, or sorry, this gets to the supply side. So we know the demand side is coming down. Businesses do not want to hire as many people, but also the supply side is coming down as well. There's just not as many workers in the workforce. You can think about the last of the baby boomers have pretty much retired.
Mhm.
And so with baby boomers leaving the workforce, we also have a serious constraint on immigration. So a lot of those folks that were immigrating into the United States and filling jobs, those folks aren't coming into the United States anymore and not filling jobs. So you sort of have this like perfect storm where the demand is coming down, but the supply is also coming down. So the unemployment rate isn't really ticking up. So it's a strange time right now in the labor market.
You know, let's talk some more about the consumer then. Consumers are starting to show signs of strain. How do we think that might affect corporate credit market in the coming months?
Yeah, here's my slide on the consumer. So the consumer is definitely starting to show signs of strain, but not deep strain. And so what I mean by that is if you look at the red circle highlighting the purple line and the orange line, you can see that credit card delinquencies, so folks that are late on their credit card payments by 90 plus days, has definitely ticked up. And this other category. And you can think of the other category as like personal loans, a boat loan, something that wouldn't fit into a mortgage, home equity, revolver, auto loan, or credit card. So it's basically any other type of loan that you could take out um, that doesn't fit into those categories. So those two spots are ticking higher. So the delinquency's there. So you say, okay, I'm worried. I'm worried about the consumer. The consumer is starting to feel some strain. But what is not ticking higher? Home equity and mortgages. Look at those green lines and the black line. So the average household in the United States has really delevered from where they were in 2008. And that's one of the challenges that the Fed had. And so if you think about where the consumer is, they've delevered since 2008. A lot of homes are just owned outright. There's no debt on them. A lot of people have taken down their home equity lines, whereas they were using it as sort of a let's have some fun, let's cash out, and let's, go to Disneyland. Folks aren't doing that anymore. So the consumer's in a really healthy spot. Additionally, a lot of homeowners have mortgage rates that are locked in for 30 years at 3%, 3.5%, some even below 3%. And so when the Fed raised rates by 525 basis points, those consumers were saying, yeah, doesn't impact me. I'm good. I'm in my house. I got my financing locked up. I don't have any credit card debt. And that's what allowed for this runaway inflation. But now, if you start to see some weakness in the labor market, if you start to see people losing their jobs, and if you start to see credit card delinquencies and the labor market not being great as far as getting a job. It's okay if you've got a job right now, but finding a job has been a lot more challenging. Then that just puts the consumer a little more strained. And when we look at some of our retail analysis for those companies that we follow in the retail space, you can see that the retail space right now is very much being driven by the luxury brands.
Hmm.
Leading us to believe that it's the most wealthy in our economy that are continuing to spend, whereas the folks sort of at the lower end or in the middle end are really starting to pull back on their spending.
So you mentioned mortgage rates, obviously, and even though it's not directly related to cash liquidity markets, everybody always wants to talk about mortgage rates. Everybody wants to know when are they going to drop? Do we
Yeah.
ever see it becoming cheaper to borrow money again?
Yeah, I wish I had the answer that people want. but really mortgage rates are where they are for a couple reasons. One is the back end of the curve is not reacting as people would hope it would. In other words, the Fed is no longer doing QE. In fact, they're doing QT. They're letting their balance sheet grow smaller. And so the difference, let me just pull up one slide, between the existing mortgage rate and the current stock, you can see the current stock of mortgages. So those are the mortgages that are outstanding, are sitting at about a rate of 4.11 at the time that I printed this chart, which looks like it was September 8th, versus the existing or the current coupon for new mortgages is about 6.55. Um, and so that's, we're just not, in my opinion, going to be closing that gap anytime soon for a couple reasons. One is interest rates in the back end of the curve are higher, and I don't think they're going to go dramatically lower. We might see some rally in 10-year and 30-year yields, but nothing really dramatic. And also, the Fed is a major owner of mortgages. Um, and that's this green section here that represents all of the mortgages that the Fed is holding. And the Fed has said that they do not want to they don't want to hold mortgages. They're going to continue to allow those to roll off their balance sheet. And so as they let those roll off the balance sheet, then the private market needs to absorb those. And so there just isn't going to be the bid, to use the bond speak language, or the buyer that there once was when the Fed was in the market buying. Recall that the Fed was a big buyer of mortgages in the decade of 2010s because they were really trying to restart the housing market. They were really trying to get the housing market going again because it was so broken after the the global financial crisis in 2008. And so they're just not going to be doing that. So unfortunately, I wish I had better news, Laura, but I don't see mortgage rates down at 5 or 4% anytime soon.
So sad.
Hmm.
We're coming up on time here, so I just want to ask, a couple more questions, kind of bring this all back around now to our bigger picture on the markets. So when do you think we're going to start seeing liquidity start to flow out of the system again? When will cash funds, LGIPs, money market funds, so on, start to lose money? When will cash be put to use? What do we see happening right now in our space?
Yeah.
Like,
So there's really two parts to that question. There's an extraordinary amount of liquidity in the system. We have right here is shows these are these are just ICI money fund balance report in the green here, and then these are all commercial bank deposits. And you can see we're upwards of almost 26 trillion in just total cash in the system. And this doesn't include like private money market funds. It doesn't include LGIPs. It doesn't include separately managed accounts that a lot of folks have to manage their own liquidity. So the two parts to it are like who's sitting on all this cash. There's individuals that are sitting on a lot of cash. There's companies that are sitting on a lot of cash. And then, so you're saying, well, what are they going to do with that cash? There's asset allocators, and then there's the corporate balance sheet. Those are sort of the two big categories that I keep an eye on. From an asset allocator standpoint, they're waiting for something cheap, right? They're just not seeing that. So they're waiting for credit spreads to widen. They're waiting for equity valuations to fall. They're waiting for, a repricing in the real estate market, whatever it is. They're just waiting for some pocket of value to come forth before they decide to asset allocate and rotate in. And this is a conversation we have with asset allocators all the time, is they're just waiting. I mean, the most famous person waiting is Warren Buffett, right? He says that he's sitting on extraordinary amounts of cash and not going anywhere with that until he sees value. How does value show up? Value can show up through some sort of recession, some sort of market correction. So that's one. Then the second group of cash holders that I speak to most often is just corporations. Corporations, their business has been very good. They've been selling a lot of widgets or selling a lot of services, whatever. They're holding extra cash. There was, when I met with corporate treasurers last fall, there was a lot of talk about, oh, post-election, we're going to redeploy, we're going to CapEx, we're going to R&D, we're going to, pay additional dividends, et cetera. That pulled back a lot in the first half of the current administration. We obviously had the concern around tariffs, ultimate tariff announcements, and then there's sort of this nervousness. Now we're starting to hear more confidence in spending, particularly with the big beautiful bill being announced and how people were thinking about that as far as the economy going forward. So it's possible that corporations start to deploy that money through whether it's acquisition, CapEx, R&D, et cetera, as I mentioned, but we're just not seeing any signs of that just yet. So we're waiting. We're waiting. I don't know when that day is going to come, but that's kind of how we think about those two markets.
We're going to end kind of on a wild card here. What is the most misunderstood thing about the markets today?
Yeah, that's a good one. I think for me, the thing that I think is going to be the most important thing to concentrate on this year is going to be the employment picture. Really keeping an eye on that employment picture is going to be really important. People continued to spend. They People continue to spend as long as they have a job. So as much as the strain of inflation is real, as much as food prices, as much as goods, services, et cetera, the cost of all of those things has gone up and up. As long as people continue to have jobs, they will continue to spend. And so if the unemployment picture starts to increase, if people start to lose their jobs, if companies start to lay off, that's when you're going to start to see spending really change. And so that's going to be one of the things that we're going to keep a really close eye on. Um, the other thing that I'm fascinated by, and something that I'm keeping a really close eye on, is the crypto space,
Mhm.
specifically the stablecoin space. There's a lot that's going on in that space. The Genius Act sort of paved the way for growth in that space, and I think that's something that's going to happen. I'm always impressed when I attend conferences to see how many technology companies are there and what they're talking about and what they're doing. Obviously, AI, everyone's talking about AI, and that's nothing new. But the stablecoin space, I think, is going to be really interesting to watch develop and um, how that impacts the payment rails and how it makes payments a lot easier for a lot of people.
Awesome. Well, we went a little bit over time, but thank you so much. Well, these are always great conversations. I hope everyone enjoyed this today. And thank you to all our participants for spending part of your morning with us, especially on a Monday morning. We really appreciate it. So I hope everyone has a wonderful day. Thank you, Will, for all the wonderful insight, and we'll see everyone next time.
Thanks a lot, Laura. See you later.
Bye.